What's up, Outliers? This is a highly impromptu open pro stream. Literally, like just a few minutes before the stream, I was talking to the community to see, is there anything that we want to talk about today? Because I was in the process of building a series of practical application quiz questions, which is still going to be on the docket. There's no escaping that, everybody. So I wouldn't get your hopes up. It's still happening. Don't worry. However, one of our members did ask a couple questions, and this conversation, I think, is pertinent to literally everybody, which is why I reconfigured the stream at the very last second to open it up literally to everybody, because these kinds of things have really, really profound potential impacts. And I think it is absolutely worth discussing broadly. So for those that don't know, Thursday is the skill development stream. So we just focus on building new skills, sustaining existing skills. So we spend a little less time today looking at the market. Sometimes we do it towards the end, but we spend most of the time sharpening the sword. So let's take a look at the scenario for today. Because like I said, this is like unbelievably relatable. And the scenario that we're going to review is funny. I was doing a podcast recently where we talked about some of this stuff. I think the episode will come out in a couple weeks. This was me on somebody's podcast. And we talk about some of these behaviors. So I'm excited to take a look at these together. So let's grab them. And, well, first, Joey, are you on here? Because if so, I'd love to hopefully direct as much as okay, cool. And let's talk about what Joey's asking, which is, again, it's really thoughtful, which is very cool. Like, this is a super cool question because I'll explain why. First, we need the drawing pad. You guys already know that. So let's break this question down into the key components. And also let's yell at Thor. Thor, stop. Okay, so yelling at Thor is done. Let's break this question down into key components. The first thing, habit of cutting some of my earnings trades early in the morning and should wait for volatility to settle before closing. So let's deconstruct this into its components. So the first thing, we have an earnings strategy, and we're taking things down early. So exiting early with respect to time. Okay, next piece. I think it's based on trying to erase some of the larger losses to help come back to scratch P&L. So we have a little bit of like loss psychology. To talk about. And down here it says, additionally, for strategy analysis, keeping track of the extremes, the maxes. If I disregard those two outlier losses I had, when analyzing, my expectancy is positive. So we have a little bit of analysis bias. Potential. We'll label this as potential because it's not fully confirmed yet. I'll probe a little bit. And then we say if I cut those tails, essentially, does it make sense to evaluate the strategy? So we'll just, the fourth component to this is like actual strategy evaluation, which we actually did a thing on this not too long ago, but this is like a great practical example of a subcomponent of this. And 5 is I'm thinking of changing the system so that it would call for reanalyzing trades in separate buckets. So system dev. Okay. So let's let's work through these. Now, again, I cannot explain how awesome these questions are because it really does show a progressive thought. Like the average trader off of Reddit is not thinking of these things. So this is exciting to me. I think the questions are very introspective, which is awesome. So let's just work through these in order. Some of them are easy. Some of them will take a little bit more time for us to discuss. The first thing, I would do my absolute best to vacuum / compartmentalize these different elements that we're going to discuss. So the first thing is exiting early with respect to time. So if we were to think about how to, that's probably not going to be very visible. If we were to think about how to solve for one, for those that are hanging out on the chat, on the stream, what are some of the things that you would think about or consider if we were to try to address this very first problem in a vacuum, meaning we're not adding any of the other ancillary details just yet. We're thinking of this purely from the context of we notice that we are exiting our earnings plays early in the day. Now, while you guys are brainstorming and sharing your thoughts on that, to give context on this thing, a good example is let's just do like a quick back in time. Let's see what on demand lets us go back into. How close back is really the question. So it lets us go to the 5th. Okay, so let's go to the 4th. And then we'll see what was reporting on the 5th. I just want to show you the actual effect that we're talking about because it's really, really important when we're talking about trading earnings. So let's grab the calendar. And fuck, this isn't working. Can anybody remind me what was reporting on the 4th after the close or the 5th before the open? If not, I can find something, but I just don't remember off the top of my head. The 5th, most of the stuff that I put on was on the 5th. So that would have been after the close. The 4th, I didn't have a whole lot on. So HIMS, okay, great, thank you. So HIMS was the 4th after. Perfect, thank you. Lauren says, what's the question? The original question that I want your guys' input genuinely is this first part here, which is if we were to start solving for this problem set, the notion that we think we're exiting our earnings plays too early after the open, what are some of the things we could do to remedy that? Or how can we approach this problem? And while you guys are brainstorming, I'm showing you the impact of this. So let's take a look at HIMS really fast. And this is the 4th of August. Let's do this later in the day. So we'll have like a proverbial entry at 12:30. And once this updates, we're just going to do a short straddle so that you can see the total impact. We're in the old pre-buffering. There we go. Okay. So we have a short straddle here. So now what I'm going to do is fast forward time, except I'm going to go to like right after the open. So we'll do like 0632. And let's see. So we got in for 1082. What we want to do is monitor what is it worth? What is this number update to? And I don't remember if, did I trade HIMS? So, okay, so this updated. So if we take a look right after the open, we essentially would have sold this for 1082 2 minutes after the open, it's at 1067. The total price change was, let's actually track these, because I think it'll be a really cool comparison to see what happens to the vol picture. Discharged. Okay, cool. I can unplug this. Get out of my way. So we have hymns. So we're going to look first at 4 AUG, and then we're going to look at 5 AUG starting at 0630 or 0632. And then this was at 1230. So here we got in to the position. It was $10.82. 1082. So this is time. This is straddle. And the straddle here is for the front expiry. Okay. So this is 2 minutes after the open. Since we're already here doing the work, actually, I'm going to just take us to 0630. We're not going to go minute by minute, so don't worry. But I do want to start earlier. And we also need spot price. So that we can deconstruct what's happening to the options. So we're going to start at 0631 effectively, because it's 55 seconds. Okay. So at our entry to begin, so it was like right around the close on the day before. So we would have been at like 6260-ish. So now we can accurately compare. So right now spot price is 64.79. Straddle is at 1180. So let's start. Let's start what's here. The fascinating thing is if we just ballparked what the expected range is for this move, it's essentially expecting an $8 range and $8 to $9 range. And if we look at the difference between these to start, we are entirely in range. Now, one important admin note is this is the end of week expiration. So we still have a few days. So it's not going to be directly paralleled here. This is why trading weeklies is kind of important when we run these to actually try to isolate vol. But the important part is this. It is well within the expected range of $8.88, yet the straddle went up in value 1 minute after the open. Okay. Next is let's go to 0631. I'm going to go to 32. Spot price at 0632 is 64.79. We're going to go in 5-minute increments in a minute. Don't worry. I want to give you like the first 5 minutes so that you can see literally how price is changing and then how the straddle is changing. So the straddle is now 1180. Let's go to 0635. Oh, the time didn't change. That's my bad. Fuck. Wanted you to be 32. Oh, there it goes. Okay, so 64.32. 64.32. Straddle is now at 11.37. What I want you to pay attention to is really the changes in the straddle price. This bottom number is spot straddle. And we'll be able to track how the straddle evolves. So the straddle originally went up 98 cents, yet price really hadn't moved that much. There you go. So this is the changes in spot. Sweet. So now we can see the beginning of a very interesting scenario where we entered, the stock did not move that much. The stock moved $2, and yet price change 3.5%, but we saw the straddle increase by 9%. Okay. So then we fast forward literally 1 minute. We see the spot price change by 50 cents, contracting 0.7%, yet the straddle now drops by 3.6%. What do you make of these numbers so far? Does anything stick out to you between literally the first 2 trading minutes? Because I think there's a couple really useful takeaways. The first thing is you are getting a good view of what volatility is doing early in the day. So even though spot price is hardly moving, right? If we were to figure out what the net deltas of this position are, it's not that difficult, right? So I'm not going to go super far into the weeds here because this is my disease, is I can just like double click into things ad nauseum. But we can figure out what the deltas are, right? So we're short 47 deltas here. We're long 52 deltas here. So we get 5 deltas. So our premium should be changing by a nickel for every 1 point change. We have a half point change. So that essentially by delta, we should have moved 2.5 pennies, but we didn't. We moved almost $0.50. That allows you to isolate what vol is doing. Time is also passing, but in these windows, it's very, very small. Mikhail says, I wish your text would be larger. It's tiny on my 1080. Is this, I don't know if I can go more than 300% or 200%. Can I go 3? Yeah, it looks like this is the max it'll let me do. So I'll just keep making sure like I'm saying what's in there, and then we can crowdsource getting you some fucking glasses. Okay. So let's, oh shit, I didn't mean to get. Okay. So let's fast forward now to 635. $0635. Spot price 64 looks like, well, we'll see. 37. So we're up a nickel. Let's see what the straddle is doing. Oh, big change. 1042. So the straddle just lost another 8% of its total value. The spot price effectively didn't move. Again, if we were measuring the total delta impact, let me add the numbers here. So this is spot change dollar, spot change percent, straddle change dollar, straddle change percent. I want to make sure that you guys are able to follow along as I fucking build these random ass. And then let's take a look at straddle net deltas. So we know our net deltas here was it long or short a nickel? I think it was a nickel here. I think it was long a nickel. What's our net deltas now? We have the 65. So short 52. Oh no, so the other one would have been short a nickel. So we're short 52, long 50. So now we're short 2 deltas. So again, if I were to estimate how much this option premium should change based on this move, it's from here. But again, remember, this is 2 pennies per 1 point move. This is essentially no move. Yet the option fell by 8.4% in value. This is vol. So we literally can track the gradient of vol. And we can say, how fast does this go throughout the day? And so far, HIMS is an insanely great example because it's not really moving in terms of price. We don't even have to rip out the delta impact so far, which is actually kind of fun. So now let's go to 40. Oh, we'll go to 45 just so that I don't spend too much time because I realize we're still on the very first point. Spot is now 62.99, so we'll just call it 63. Our straddle is at 11. Net deltas on the 65. We have 52 here, 48 here. So we're short 4. That's your net deltas. So now the straddle is rallying in price a little bit. Let's go now 15 minutes will take us to 7. Price is now at 63.93. Our straddle is now at 1067. $49 here, 51 here, long 2. We'll go to 0730. This is Pacific time, by the way, in case you didn't that up. And let's see where that puts us. The purpose of this exercise is one example of just tracking the movement of vol following the open after earnings. So this should help give you some context on how vol is changing. So now we're at 1075 at 64.88. So 64.88, 1075. So if we take a look, what's our net deltas now? 46 here, 54 here. Notice how the deltas are even rising, even though it's effectively at the money. That's also actually pretty interesting here. So this is long. You're now long still. Oh, fuck. 54. Now let's go to 08. We'll go to 0830 just to speed this up. The cool part about this too is that it's really bouncing right around where it was. It didn't have some sort of big drop, which is causing vol to spike. This is actually an insanely cool example to use. So the straddle's now at 1035 and price is at 64.84. So price is still just bouncing right around where it was. And our net 47.53 long 6. And then let's do Kirk says HIMS did drop big at the open. Did it? Oh my God, I'm on the fucking 4th. I am such an idiot. Was it 4th after the close or 5th before the open? Yeah. Oh, it's after the close. I am a fucking idiot. So what you can do is Men in Black, flash your brain, because we need to go to the 5th. So let's go to 0631. This will look like a repeat. Well, now you have an idea of how vol changed the day before earnings. That's kind of fun. I was wondering, I was like, man, this is fucking staying like pretty propped up for a hot minute. Kirk says, so how do you explain that vol effect on the options the day before? I mean, it literally just shows you how volatility moves. Volatility is not static. So I explain that behavior by looking at it and saying, this is volatility moving. And this actually makes a lot of sense. This is why it was actually confusing me a little bit as we were doing it, because if it did have a big drop, I would expect to see the straddle oscillate a little bit. But this is like going down 8, up 5, maybe. But this back and forth of positive behavior would be quite anomalous, especially this far out in time. So that part was confusing me a little bit. That's why I started going further in the gaps to try to figure out when it would have bled out. But that shows you how vol essentially moves over these different durations within a given day. So let's take a look now at what our straddle, there we go, 56, there we go. Now we're good. Yeah, perfect. So our straddle at 0631 is now at 1130. So this is actually a really, really good side by side. Let me do this. Because this really isn't wasted effort at all. This is all just for AUG. And then what I'll do is effectively copy this so that you can compare over the same time frames the day following earnings. What a pleasant mistake. I actually think that this will help quite a lot. We'll just leave. Okay. So at 0631, spot is now at 56.03 and our straddle was at 11.3. So if we took a look at the net deltas of the straddle, this looks kind of broken. Let's go another minute. I can't get the net deltas from here because it looks like it's too buried. So we'll see if it will normalize as it comes out. So we don't get net deltas yet, but at 0632, confirm we're at 0632, we are, which is good. Our straddle is now at 910. This is much more in line with what I would expect to see. 56.73. Because again, even still, if we look at the move from close to open, this $6.57, this is still within the expected range, right? So if we use the original straddle here to, again, give us like a generalized expected range, it should be within this $8.50 range, and it's well within that $8.50 range. So the straddle is still happy, and this is why you see the straddle coming down as it is. So now let's go to 35. Now, Joey, back to your scenario specifically, what time were you taking down the straddle? So now the stock is at 55, and the straddle is at 910 or 35 still. Which the fact that it remained steady here, despite the fact that the stock went down $1.20, that tells us that vol did come out. It just was essentially flattened out by price movement. Joey says normally close between 10 minutes and a half hour after the open. Okay, got it. So now let's go to 0730. I'm skipping a bit. I'm gonna put us in this bracket. $62.86. I'm just going to use the same price from before. So essentially over the first hour, from 0635, we moved 7 points, which is about a 13% change off of this. So this is at this point like a pretty significant. So now the straddle is at 604. So the first thing we notice is that if you close within the first 5 minutes after the open, you effectively get 19% contraction in your premium. If we do it about an hour, you get about a 47% contraction in your premium. Again, this is for this example. Let's go to 8:30 and then 09:30. And these will be the last two stops on this. Oops. So 08:30. Because the other thing to remember as we're looking at this is like you still don't have that full directional exposure. You're still offset on your deltas because in this case of the straddle. So even though the underlying is moving a lot in terms of direction, you're really muted in terms of how much of that you're experiencing on the straddle. So now we're at 663. So the straddle has gone up slightly and we're at 59.92. So the first thing that we can clearly see going on here is the volatility contraction in the first few minutes, like 10 minutes of the open, is super, super strong. It's effectively overwhelming a lot of the price movement. However, after that, we start to see it slow down and we can literally see the straddle is now gaining in price as the stock is moving. So what does that tell us about the behavior of the straddle and volatility specifically between this point and this point? Who can tell me? In the beginning of the day, you're seeing a very different behavior. Where he says contracts hard, then correlates more with spot price. That's essentially the relationship you're seeing. So what this is showing you is in the beginning of the day, volatility is coming out at a cyclic rate. It's coming out super, super fast, right? It's overwhelming a 6% move. It's overwhelming, or I'm sorry, a 6-point move. It's overwhelming another $1.18 move. We're seeing the straddle contract nearly 20% from 631 to 632 as the underlying literally moves about $1. So at this point in the day, the vol is super, super strong. Now, if we go to 0930 for our last stop, let's see what happens. Give me 1 sec. I got to let the dude in. Ooh, straddle's now at 846. Spot price is now at 57.26. So now we see a very clear gap. We see all of a sudden the price sensitivity of these options is coming up, and it's not immediately being completely overwhelmed by the delta. So in this case, as this thing came down $2.66, your premium went up by $1.83. So not only is the delta component, but volatility is actually expanding at this point, slightly. So then let's take a look at one more stop earlier. So we'll do like 0645. And an important note as we're doing this is all in the context of, one sample, which is definitely worth keeping in the back of your brain. But this one sample, I actually think is a really, really good, it's a really good example of how these things can move. So spot here is 58.68, 69 technically, but whatever. Straddle here is at 766. And then we'll do 7. That'll give us like the first hour of the first half hour broken out into its subcomponents. And then you'll be able to essentially decide for yourself on what you see. This is also accompanied by a crazy rally at this point. Straddle is at 603. Spot is at 61.97. This is 0700. Okay. So coming into earnings, we see our straddle kind of oscillate around a little bit, bouncing up, bouncing down, changing, but not changing a whole lot. So it's changing by 9%, down 3. This is a pretty big change right after the open, but this is also normal vol. You're going to see different kinds of moves. Then right before market opens, there's a buildup of positions, especially around earnings. Market opens, and we see vol expand slightly. The fact that vol only expanded this much tells you how much it actually contracted in the event, because it's now being counteracted by actively trading vol, people looking to get in right after the open. From there, 2 minutes after the open, vol is down 19%. If you look at the day before, again, for general context, the highest vol was first minute after the open, and then nothing really is even close to it from there, meaning close to like a 19% drop. Yet, if we look through the rest of this timing, I'll expand these a little bit so it's easier to see here to here. Yet on vol day earnings, we see vol drops 19.5, stays flat, goes down another 15.8, goes down another 21.3, flattens out, and then starts skyrocketing up to 27. So the main thing is the total percent change in the straddle is pretty haywire on the day. So if we were to apply this kind of analysis, it's really, really useful to understand how vol behaves in the beginning of the day for the strategy, and then how it behaves over the course of the earnings day, so that you can then determine when you, based on your approach, might want to exit. Joey says, didn't mean to monopolize the stream. No, that's the reason why this is a public stream right now is because this was a really good series of questions that I think just about everybody should know about. That's literally why this is on a public stream instead of keeping it just on the Patreon like the Thursdays usually are. So I wouldn't apologize for it at all. Like, your questions are essentially the catalyst for bringing this information to people. I guarantee you, if you ask somebody like, hey, where does the most vol come out on earnings day, people would have lots of guesses, but they wouldn't have any sort of quantitative understanding. Now people at least have some sort of quantitative understanding relative to time, in a sample size of 1, but it's still a quantitative understanding nonetheless. This isn't obviously fully descriptive. So if we now pivot to the rest of our points, the second point that we talked about is the idea of, I think it's based on trying to erase some of the larger losses to help come back to scratch and then P&L. So this is standard like trading psychology, mental psychology. When I look at these responses, I still see an example of being uncomfortable with losing positions. This tells me that there still isn't that successful full detachment of our ego from losing positions or losing strategies. The reason why I say that is because I get a hint of it here, right? And this is, again, very self-aware to identify this point. But then this down here, if I disregard the 2 outlier losses, my expectancy is positive. So this is an example where we want to be able to look at this and say, like, this is value add. This is something that's driving positive returns. And I really am hoping to be able to see it that way. So a couple things from the loss psychology side of stuff here, which is actually really, really simple to get at. The first thing is working more and more to get at that successful detachment from our trading capital. Because the reality is you can go an entire earnings season and come out net negative. Easy. You can have a bad earnings season. You can have a bad couple earnings seasons. So the point there is this behavior of trying to make up for the loss on the existing strategies, it shows that we still don't have a full understanding of the strategy and the way the strategy might behave. And the funniest part about this is that this is actually slowing down getting back to break even. So to summarize these first 2 points, the reason why we might exit early with respect to time is because we actually don't know what's optimal. If we know what's optimal, then we know that the decision that we're making inherently will automatically get us back closer to where we want to be faster, no matter what, right from the jump. But the fact that we don't have that, it tells me that we're concerned that the thing might go back down and we might actually add to the loss, which we wouldn't want to see because, again, we have this general loss aversion. So the prescription here is first researching the earnings plays and determining the actual window that's most logical to take the trades down. That will add a significant ease to then executing that going forward. Because then when you take a trade down early, you'll be able to say to yourself, well, I'm probably keeping, I'm taking this down and I'm sacrificing another 30% of premium contraction on average over this next time frame. And I already showed you the way to do this broadly. You literally can just track the price of the straddle over the course of the first periods of the day. Do that across a large sample of the things that you think you're going to trade earnings in, and then you have a pretty good idea. From there, I have a profile for most of the individual things that I trade, and it's because I trade a lot of them pretty regularly. So you can even go to that level. Successful detachment from the trading capital, learning to continually emphasize the process over the outcome of individual trades. That's the prescription for number 2. Because if we're deviating from the process to try to, realize winning trades, it clearly tells us that we are not prioritizing the process. We're trying to take shortcuts to get to the outcome that we would rather see rather than adherence to the process. So in my mind, I would mentally punish myself when I deviate from the process that's laid out, that's well researched, so I have a pretty good idea of what's optimal in this context. So then if I'm deviating from that without a really good reason, I'm just not following the process. I'm not doing what I should be doing. That's the simplest fix for number 2. Number 3, we do not get to disregard outlier losses. They're there. So one thing that I would give you partial credit for is that if you were more selective in the future where the trades wouldn't be taken, that's one scenario to consider, but it's not be more selective in the future and I wouldn't have taken this trade because this one lost. The only way that you can confidently say that is if you had made some sort of adjustment to the strategy that then after that adjustment, these trades would have naturally been passed on. That's a different scenario. But even still, we don't get to get rid of them. We simply get to take them in context. From there, all we need to do is track a rolling average P&L so that we can still have a sense of where the tails are. However, we can see how the improvements to the strategy are going. So what I like to do is literally set up moving averages for the P&L so that I can track different windows. Like this. So what I can do is I can set different period moving averages. I think in this case, it's like a 5 and a 20 or a 10 or a 20. I'll tell you what they are. I actually don't know. 10 and a 20. So this is looking over the last 10 trades and the last 20 trades. And then I'm literally plotting the average P&L for those rolling periods. This allows me to visualize changes that I'm making. And then is it having the anticipated impact? So for example, the strategy clearly was performing well. And then all of a sudden there was a bad streak. There wasn't inherently anything wrong with this. It was just a bad streak. And then different adjustments were made. And you can see that reflected in the short-term average that's going to occur a little bit faster than the long-term average. So then we can see, like, are the changes we making positively impacting this system? And is the long-term average starting to chase the short-term average, which it should? So this is how you very simply evaluate the strategy without getting rid of the outliers, because we don't get to get rid of them, especially when one of the reasons why the outlier exists is this: size it down anyway. Because if a trader has some sort of issue with position sizing, and we also have an issue with following the actual plan that it's supposed to be, that's not fair to say it would be sized down in the future anyways, right? Because we already have at least a near-term demonstration that it's likely that that's not the case. It's likely that we might violate. We might do something outside of the plan because we literally have a recent track record of it. So the easiest solution there from the analysis perspective is to take the outliers in context and then apply whatever changes you think you want to make, but then track the performance of the strategy after you make those changes with rolling averages. And then with those rolling averages, you have a really, really good idea at that point of, is this thing generally moving in the correct direction? Or is it not? Or are there other things that we have to uncover? So I think this down here is, again, just an absolute massive mistake. I'm thinking of changing the rules to analyze the trades in separate buckets entirely. That's a massive mistake. This is us not wanting to look at the ugly patches. We want to pretend that it wouldn't have happened, or that it's not there, or that we only get to look at the part that we think is better. But that's not how this works. That's not how strategies work. Strategies should evolve over time, which is great, but we don't get to get rid of what happened. It's there. So we simply should contextualize what happened, accept it, and say, yeah, okay, this series of things happened. This led to this series of changes. My cumulative P&L, even if it's negative, is sloping in the right direction. So an example of this could be really simple. You have a couple tools you can use. You can use the rolling average P&L plots that I just showed you, or you literally can use a cumulative P&L. And of that cumulative P&L, you might have seen like the strategy's doing well, and then there's a couple trades that send us negative and then more negative. But then if from here we're doing this, even if we're not here yet, this is the right direction. This is completely okay. There's nothing wrong with this recovery phase. So we don't need to get rid of the two samples that led us here, but we need to be able to analyze the information that we have in context. And we need to say, at this point, I made a change. This is my change log. So change whatever, change 1. I track those changes, and then I monitor the performance following those changes. If the performance following those changes is displaying the correct behavior, meaning we're within tolerance, upside to downside, clustering looks good, and overall the trend of the P&L is the correct direction, even if it's still negative, still okay. This is the right direction. So then over a long enough time frame, this, again, provided that it is actually something good, we'll come back over this, even with these. So let me take a pause there and see if anybody has any follow-ups, but then specifically from you, Joey, because like I said, I really like these questions. I think that the way that you thought about this, it shows introspection, and it really does show like a turning of a corner in terms of how we're analyzing things. The game here is literally just taking it the next step and continuing to pursue further and further. But I thought that this was a really, really, really awesome question. And again, that's why I wanted to put it on the main channel for everybody, because I can't imagine anybody that's been trading doesn't identify with this in some way. We absolutely have all been through this exact sequence, without a doubt. But the cool part is the fixes here really are pretty simple. They're really, really, really not that difficult. But it, as always, does require a little bit of the background work. And it's a reminder that if you take the time to build well-developed strategies, a lot of these other things will start to go away. And in my opinion, this is in the process of developing a well-developed strategies. But there absolutely are going to be some kicks in the shin along the way, without a doubt. And when I say kicks to the shin, those are the drawdowns, right? So Joey says, it did feel dirty to look away from those ugly trades. I can't just start new because the reality is I can and most likely will deviate from the strat. Yeah. And the most important part is to condition your brain to being okay with losing positions. If we make a habit where we see something that makes us uncomfortable, so then we hide it, we put it away, your brain is now being positively reinforced with a terrible, terrible behavior and a terrible response, terrible adaptation. If you see something that makes you uncomfortable, the immediate response should not be look away, because in that context, again, you are rewarding the part of your brain that says, I don't like this, I don't want to see it. But that can lead to insane selective bias down the line when you're conducting different kinds of analysis and whatnot, because it's essentially feeding that part of the brain. It's saying it's okay. If we see something that makes us uncomfortable, if we don't like, we don't have to look at it. We can kind of just segment the stuff. We can call the strategy version 2, and then we can just track it going forward and not pay attention to the other stuff. The reality is there's nothing wrong with those other things. Even if you had 2 outsized losses, the fact that you're still trading tells us you didn't blow up. It tells us that you're still in the game and still able to put positions on. So with those as the context, those two positions are still absolutely part of this thing, and that's okay. So I really like a lot of the elements of this because I think it's so unbelievably relatable. Sky says, to make that easier, do the smallest version of the scariest thing, work towards doing the big thing. I kind of like that. I think that's a fair way to look at it. I think that works well too, like when building discipline and stuff like that. But Kirk says, in a strategy like earnings vol, would it be beneficial to have rules to hold until a certain amount of vol has come out? That goes back to analyzing the profit mechanism. So that's a great follow-on. So let's talk about that for a moment. If we break down the profit mechanism that we're talking about here. So, oh shit, what the fuck is that? I don't want that. So the market effect is earnings release, vol contraction. The profit mechanism, vol contraction. Within this vol contraction, we now have to apply what all of you have heard before, the outlier strategy process. We have to quantify and qualify the profit mechanism. So what are the steps to quantifying and qualifying the profit mechanism? Well, the very first thing is we have to measure it. This is the very first step. So we need to get a big enough sample, and we need things like the average move, max, min. This one also needs the median, distribution. This is like a good starting point without adding a ton of shit to this list and overwhelming people. If you do this in and of itself, this is pretty good. And if you want to make it slightly better beyond the distribution, you could do like error bars to get a sense of like ranges around each sample. But this is the thing we have to start with. Now from here, we can qualify different elements. So what I mean by this is we can say, okay, is there a difference between small, mid, and large cap earnings and price behavior? You will find yes. Is there a variance in lead-in volatility and post-earnings volatility? You will find yes. So you can then get closer and closer with this individual profit mechanism. And then based on how deep your research is, you can then determine what are the correct signals to use, whether it's a certain amount of vol needs to come out, whether it's a certain holding duration needs to happen, because the reality is the vol might not come out. The vol might not come out anywhere near the speed you thought. So then maybe we manage it if too much vol goes back in. But the main point here is that we do need something that guides the decision making so that it's not completely random. Because if it's completely random, the propensity is to deviate, because why wouldn't we deviate from something that's random? I absolutely would. And I imagine most people likely would as well. It's literally just straight up human nature. If something doesn't seem well developed, or if it doesn't seem to follow some sort of knowable pattern, but we want to keep doing it, we're probably going to try to bounce between different stuff. But the problem is if you do that while it's live, the overwhelming propensity is to make a shit ton of mistakes that end up costing us money. So it's a really, really good follow-on question, Kirk. So that's the long answer. The synopsis of all of that is it might be beneficial to have some sort of rule until a certain amount of vol comes out. It might not be. It might be more beneficial to have a time-based approach. It might be more beneficial to have one that switches between those two scenarios based on what price is doing. And it's really up to the trader to choose your own adventure. Whatever version of those allows you to most clearly identify and trade the effect. Really, really good conversation today. I like this topic a lot because, as I've said a million times, I think these are the kind of discussions and details that ultimately need to happen to build something that truly is robust. So I love the general direction of where your guys' heads are at and what you're thinking. In the meantime, let's talk about two things really fast, unless there's anything else on that topic. If there's anything else on that topic, please throw it in. It's perfect time. But I do want to talk about upcoming earnings because we are wrapping up this past week. Trying to see if there was anything that went through. No. Interesting. Cool. So let's talk a little bit about just the markets really fast. There's a handful of things that I believe are kind of interesting. Specifically, we're seeing really, really strong markets. I still have that position on in Palantir. I literally added even more. So this thing has been an absolute runner. And I was actually talking with a buddy of mine earlier today that started trading Palantir back when it was like in the 20s, I think, soon after IPO. And they've built out like a really big position relative to their account size, aka it's the majority of their account. And we're working through a really interesting scenario. The scenario is they're not like a deep options trader like I am or like most of us are in the community, but it's a really interesting case study because I think it's something that can happen to just about anybody. So what's ended up happening is they have a position on in Palantir that was built over years in terms of the equity. So it's like several thousand shares with an average basis of sub 40. Now, when they were holding that position, as it kind of started stagnating, rolling sideways in this process where it was going down, the idea was, I hadn't like spoken with them. This is kind of stuff that they were just tinkering with on their own. But their idea was to sell calls against the shares, which is fine, except they made a couple really common mistakes. One of them is over time, they ended up selling enough short calls to cover the shares. So let's use an example. Let's say that they have 5,000, they have more than this, but let's say that they have 5,000 shares at 38. This is their cost basis. Total cost of this position is an average of 190,000. This, again, is like the majority of the portfolio. So now the stock is at 182.20. So this represents a P&L of $750,000. Solid. One of the issues that they have is they have a bunch of different short calls at a bunch of different strikes. So they have some of these short calls that are at like the 165 handle. They have some of these short calls that are at the 210, like a really small size. So let me see really quick. I could tell you because I was taking notes on it earlier because we're working through a couple scenarios. Let me see really fast. Where the fuck did I take these? It wasn't a random Google sheet. That I remember. But where? Not this one. Here we go. Found it. Okay. So give me 1 sec. I'm literally going to do the average. I want to do an average basis, like weighted by the strikes. Wait, how far does that go? No, that's right. Needs to go like 111. Perfect. Okay. So their average is 178. And give me 1 second, actually. I'm going to tell them. Okay. So right now, the average is 178. So if we take a look at what the P&L is at this average instead, this minus this times this, we're essentially locked in at 700,000. So here's the question, and here's the exercise for the group. What do we do about this? If we have tranches all over the place, and again, for context, there's 11 different tranches. And they span everything from 165 to 210. So there's a bunch of stuff in the middle here. What do you guys think about this position? What can we do here in order to try and get back to what we want? For those that are sitting there saying like, why would we have 11 tranches at all these different prices? Why would we have like so many? The first response there is you're not wrong. But the second response is if we just take a look at what the average is. So again, let's say that we have 50 contracts out total to equal this. And let's take a look at those 50 contracts in Palantir. And let's just start with something that's like 40 days out. And let's do something that's like a 30 delta to start. It's like $5.80. This is how that happens. Because the trader looks at options that are 40 days out. they see that they can literally make 29 grand for something that's 29 days out. Or I'm sorry, 45 days out, about a month. And they can make 30 grand. That's 3/4 of a lot of people's fucking salaries over the course of a year. So this is an example where we unfortunately became a little too focused on the profit potential of the short calls. But in doing so, we actually end up with a position that doesn't fully align with what we want to see longer term or what we expect to see, which is this thing going higher. So let's see what you guys think in terms of what we should do. Reese says, are we nearing expiration on all? Unfortunately, no. The majority of these are actually out in 2026 at this point. So the reason for that is what you're looking at now are a bunch of positions that have been rolled at least a couple times already. Because Palantir's been on absolute tear. So to normalize us, we know what the right answer is here, right? Like if we were to start all over again, if we were to put on the position, we might sell some calls against the shares, but we would keep it to a ratio, right? Always maintain the upside. Reese says, well, we don't have to do anything right now. That's correct. We don't have to do anything right now, but what's the downside to that? If we don't do anything, the downside here is we're sitting on $700,000 of profit that is essentially tied to options that are all the way out through 2026, 2027. So what does that mean? It means that this capital is tied up on something where we have no more upside profit potential. We are at max profit other than the remaining theta to come out of those options. You follow? Because we have the short call component, we need to wait in order for the theta to come out, in order to come up to expiration, but there's a holding cost. Because right now the P&L diagram looks like this. Where this is today. We're super deep in profit. Kirk says Palantir will at some point pull back, go back to 160. Wait for a pullback, then restructure the sold calls. Do we know it's going to go back to 160? I don't know how you know that. I certainly don't know that. If I look at other price points in Palantir where I might have waited for a pullback, maybe it's here. Maybe I got in and I sold at 105. And my game plan was, I'm going to wait for a pullback so that it gets back to my basis or below the basis. It's never seen the 100 handle again so far. It still could, but so far it hasn't. And this has been, since mid-April. So the broader point to that, Kirk, is like, you really can't confidently say that at all. And that kind of thought is actually pretty poor to base a trade decision off of, because we really don't know if that is the case or not. And if we plan it as if that is a definitive case, we can be in a pretty unfortunate spot. So not a bad idea, but it might not go back to 160. It might never see 160 ever again. And that is a real possibility. Is it super likely? Who knows? I mean, we can see how likely it is. I guess we all know, because we can take a look at the probabilities. So what's the probability of us hitting 160? Let's say over the next 70 days. This places us at like a 58% chance over the next 70 days of touching 160. So it's like a coin flip, 50-50, effectively. Not quite, but pretty close to a coin flip. That's for the next 70 days. So if price goes higher over that time frame, that probability would continue to decrease. So not a bad idea, but for those reasons, not super effective. The next idea here from Reese is buy back some calls and sell shares to offset losses, like in a diagonal. That starts to become an interesting idea. So here's the thought process, the thought exercise we used. We started with, if no position, what do we want? So we're removing the mental and emotional baggage of everything that's happened. And we're saying, if we had a blank slate, what would we want this to actually look like? The ultimate goal is to figure out how can we move this thing closer to that direction. So in this case, this person really doesn't want the short calls. Funny enough, they were saying, I would rather be long these than short them. So they still have a really bullish thesis, which is cool. So if we know that to be the case, we know that we're sitting on a pretty big profit via the long shares. So if we choose to sell some of these at the spot price and close some of the short calls, what is the process? Meaning, like, what's the downside to that? What's the functional process to doing something like that? As always, the details really matter a lot on this kind of stuff. So if we have long shares and we have short calls, they also have long calls and short puts and other shit, but this is like the base position. And we choose to start unwinding these. Exactly. Reese has it. It's not only giving up extrinsic, but you're literally going to pay. So let's take a look at the scenario. We can literally build it out. So let's say that we have the 5,000. That's what we've been working with. 5,000 and our basis is 38. Not 389. That would be really bad. Basis is 38. And then let's add just a couple of these short calls. I'm just going to pick like 2 of them and split it into an average between them, just so that I don't add them all, because there's a fuck ton of them. So we'll do 18 Ds, 26. And I'm going to say the average weighted price. Well, we can literally do the exact average weighted price. One sec. The average weighted price for these is divided by this. That is incorrect. That's correct. That's correct. So it's like 170, like 170. So let's do the 170s. And let's say that these were originally sold. We'll do half of them. So we'll say that we have 25 here. No, it's actually weighted more than that. So we'll say we have like 40 here. And let's say that we sold these originally. What would they have been back when the stock was like here? What is that? 60 points lower. So 60 points is here. So it would have been like 350. Or I'm sorry, 35. So that's the first tranche. And then the second tranche in the example is out here in 17D. So again, I'm just doing kind of like these weighted averages for them. It's across the entire expiration cycle. And the average here is like 192-ish. We'll call this 192. So that puts us, I'm going to pick the 195s. And again, 60 points lower from here would be something like this. So those would have been on for like 46. And we would have a 10. And a lot of these bad Larrys. Okay. So let's take a look at this position. The downside to this position, as we know, is that we absolutely are going to hit our max profit. Again, this is not directly representative because we're missing, you know, all the stratification across the lots, but it's close enough. We can see like we're kind of there. Like the total max profit does increase a little bit further as we go out, just because delta will gain on the short put side or on the short call side, but it's not that far off. So how can we think about this? And it's actually simpler than you might instinctually think. So we know a couple really important factors. So one, we're essentially at max profit in terms of delta. In terms of theta, we have, well, let's see what the actual difference is. At 183, we're at 624K against 821, 624 versus, fuck, what did I say? 841? 821. So the functional process here is if we did choose to sell to close some of the shares, here's essentially how that process works. So we would sell to close shares. Again, let's just say we do the 5,000. We sell to close 5,000 shares at spot price 182.20. And this gives us the proceeds. At the same time, we're going to buy to close the 40 lots at, let's see what the spot price is for these. For the 195s, spot price is like 62. And then for the other options that we have, the 170s, spot price is at like 56. So now we can see and clarify our scenario. So if we make this trade, we originally sold this 40 lot for 35. So 56 minus 35 is 21 times 40. 100 is 84K. So that's what goes out of pocket there. Then we have the 62 less the 46 times 1,000, which is 16K. 182.20 minus our basis of 38 is 144 points. 144 points against 5,000 is 721K. So what do we stand to make here? Well, if we have 821,000 less 621, we have 200K remaining that we would make. I don't know why I put a K in front of it too. We have 200K residual. So who can tell me the logical way to make this decision? Do we wait? Do we take the short calls down? How do we do this? I'm going to leave this on while I grab another water. Right. Highest after-tax return. So here's the issue with higher after-tax return focus is that it focuses on right now. That doesn't really position us for what we think it might do in the future. So I wouldn't personally make the decision on the highest gain right now, but that would be part of the calculus. Joey says we can buy more shares to get back into the desired ratio and let things get called away potentially. Good example. Let's pretend in this scenario that we're using all the capital that we have. Sky says you're delta neutral. Just delta hedge to collect. What would you delta hedge? If you're saying that you're delta neutral, which, I mean, realistically, this isn't delta neutral, but if this was delta neutral, what would you hedge in that scenario? What delta hedging would be done? While we're thinking of that, add puts. But you said that's all our money. Yeah, because you mean add puts via selling puts or buying puts? Buy puts. So why would we buy puts if we're delta neutral? If we buy puts at delta neutral, that means that we would be short deltas in something that we want to be long deltas. Joey's onto something here. Joey says, my first idea would be to buy to close the lower strike tranches while closing some of the higher tranches at a profit to cover some of those losses. So in this case, that's absolutely a viable partial idea. One of the reasons why this is a viable partial idea is because as the 170s get further and further in the money, there's less and less extrinsic value that can even come out of them. So the example that looks like is that's effectively us moving along this direction. And you notice how the further on this direction we go, the space between these two contracts. So now, Joey, you're getting onto a really, really important point. This is the opportunity cost of the held position. So what we need to do is figure out what our current position value is, which is 721K. So now what we can do is we can say, what is the percent return to get this 200K? So we have $200,000 divided by 721. This case is a 27.74% return. Okay. So now we have some planning factors. Effectively, what this is saying is as long as Palantir remains at or above our two short strikes, the 170s and the 195s, we effectively are going to make 27.74%. SkySetX, so if we're at 0, spot or time moves, delta moves. When you get positive deltas, buy puts. That doesn't really help you though, because the puts are going to be really expensive. And then again, if you're buying puts to flatten out your deltas, that's a really expensive way to do it. So that doesn't really like play charm really at all. Besides that, we're talking about options that are really, really far out in time. So charm for stuff that's at 2026, 2027 is going to be minuscule. Delta decay at that point is very, very low. So not a bad idea, good brainstorming input, but yeah, it wouldn't really be that effective in this context. Not a bad idea though. So the question here, Sky Shadix says, because it's such a large position, the charm should be more pronounced. I mean, not really. This still isn't that big of a position. Like 50 lots is not, that's really not a big position. For charm to become a meaningful factor, that's when we're talking like thousands of contracts. And Reese is highlighting a really, really important point is we don't want to be delta neutral. We want to be long deltas in this scenario for, again, the person's expectations or what they want to happen. So what I've given you is a base scenario. Right now, we are tying up $721,000. That's the current value of our position. That's what we could cash out at right now. We're tying up the $721K in an effort to make $200,000 residual that's left here. That's what we stand to gain from this side of the equation. So then, if we choose to realize these positions, let's do the math here. We would make 721 less 84 less 16. That gives us 620K. Positive. This is what we would make if we flattened all this stuff out. So then the question becomes, is there a way for us to make 27.74%? This is before taxes, which should be part of the conversation, but keeping it simple for now. Before taxes, this is pretty easy to outperform if we're trying to do it over the next year or two. Well, really year and a half or 2.5 years, because we're using like I think the D's 26 and then the D's 27. Yeah. So a year and a half is the minimum. And then 2.5 years is the longer one. So we would have to lock up this in order to get this for these durations. So then the total P&L that we would get for holding for both these durations is 27.74%. And it requires keeping this tied up. So now instead, if we look at scenario 1, which is flatten, we walk out here at 620K. And then we can take this 620K and really do whatever we want. One of those ideas could be leaps. So let's just eyeball this really quick. if I were to take some of that money that's realized and I go out to 15 Jan 27, I go to the 200s, they're liquid. I guess you could do the 185s as well. We'll do this is fine. Let's get rid of the rest because we're pretending we flatten those. These are going for 46.45. So the 200 calls are at 46.45. So if we wanted to essentially replicate this position, we have $620,000 divided by 46.45. So you can get 133 of these if you wanted to use all the money. So let's grab 133 of these. And let's analyze the price behavior. So 133 of these, 133 times 46.45 is 617,785. This is our cost. So let's say over the lifespan of this, we want to estimate what we might make to see at what point, at what price level do we beat what we would get from here. So again, the whole purpose of this is to make a logical choice. We need to figure out where do we get a 27.74% return on invested capital or better. Again, once you include taxes, you're going to be talking like 35, well, depending on your tax bracket and all that shit. So let's just eyeball a few scenarios. So we're saying that we're going to have 133 and we're getting those at 46.45. And this is what spot at 182.20. So let's take a look at what the value of our of a contract would be if we were at, let's say, 190, 200, 210, and like 250. Because again, we're talking 500-day options. We're talking pretty long-term time frames. So let's see what the P&L would be at these different positions. So what I'll do for that is actually simplify the exercise. And let me add different price slices. So that's 1, 2, 3, 4. We need 4 price slices. I need one more. Okay. So our first slice is going to be at 190. Second slice, 200. Third slice, 210. Fourth slice, 250. So we can already see from a P&L perspective, where are we better than this $200,000? Effectively, if Palantir goes to 210 or above, we're now net positive by 10% plus. So now the question is, this is a really high probability trade. This is, to get this 200K, you effectively just need to stay in the position. So what's the probability of us getting this money, the 233 in this scenario? Again, we can use options. So what's the probability of the 210 being touched? If we take a look at the probability of a 210 being touched, it's 79.4%. What's the probability of 250 being touched? The probability of 250 being touched before expiration is 56.5%. So what this shows us is there's a really high probability of getting the upside move that is likely to dwarf what you stand to make by remaining in the position and having the upside capped in this way. Now, the cool part is this stuff is never really binary. The cool part is you can take down some of these. So let's say that you don't want to have a tax bill against 620,000. What's another thing that we could do? We could literally say, we know what we're taking down here. We're taking 100K down. So instead of selling the entire stock position, what if we sell 100K worth? We don't have a big tax bill. We would have removed all of the upside risk coverage. And now we have something more in line with our desired position. Now, the downside to this is you don't have the long calls at this point, but this is another way to be really efficient about the moves. Now, there are wash sale rules that you have to be thoughtful about in these kinds of scenarios and the different trades that led up to this point, which do matter. But the main thing I'm trying to show you guys is a really strategic way to think about managing in the money short calls. And you can see that we can make a logical decision based on the numbers, but it's super important to have some sort of numbers to base the decision on. So let me take a pause there and see if you guys have any questions on what we covered for this. And I'm updating the title for this, Managing Deep in the Money Short Calls. Okay. Keeping all of our stuff updated so that for the pro members, I keep like a library of all of these so it's easy to find the videos. Perfect. So let's see what you guys think. Kirk says, isn't part of the position preparation to think about downside risk too? In this context, the downside risk is already baked into the position size. Kirk says the covered calls would provide better long-term risk management than the leaps, while they could have similar odds of being 200K profitable. So in this case, the covered calls absolutely would have better risk-adjusted returns, no doubt. However, they do not have similar odds of being 200K profitable. Technically speaking, the short calls literally are like 20% better. But in that scenario, we're also not comparing apples to apples because we're comparing the stock getting to 210. And if it gets to 210, this would be 10% better than this. So that's kind of part of the calculus. I'm not purposely getting us to net out equal at that exact point because we're compensating a little bit for just friction. But the backdrop of this is that we have a position that we're managing the risk by the size that we're putting it on. Like we want this risk. So while the covered call will have a higher probability of making the 200K, it has a high probability of severely underperforming on the upside profit potential due to being capped. Sky says, how many shares was the original position? In this example, we're using 5,000. That was kind of built over time. The average for the 5,000, the basis was 38 for the example. Joey says, are tax straddles still a thing? I think it kind of depends on your tax footprint. I actually need to understand wash sale a little bit better. Sky said, Sky Shadix says thanks. Yeah, absolutely. Of course. Reese says, not a question as much as I need to watch it again. Feel like I missed the actual explanation. Actual explanation for what part? Because I'm happy to recap it for you while I'm going to ask Gemini to research current wash sale rules. Because for those that don't know, one of the benefits of flagging yourself as a day trader, or technically like a full-time trader for the IRS, you can elect mark to market. So you lose the ability to have long-term, short-term capital gains, but you gain the ability to not have anything disallowed. So all of your trades are completely allowed, which is pretty solid. Reese says, I thought I was following, then I heard, so that's how. Missed some of the in-between. Also, wash sales are a bitch. Yeah. So I don't remember the so that's how, but the main thing is there really isn't a point in this where it's like, do this. The main thing is identifying how a trader can make a logical, quantitative decision-making process around the position. Okay, so let me see. Current wash sale rules. If I am long stock, sell short calls, but buy to close calls at. Okay, so I'm using Grok for this one, and then I'm going to do my usual. I'm going to paste it in a couple. I'm going to drop it in Gemini, and then I'll also drop it in ChatGPT, and then I'll let you guys know what the answer is. I essentially am asking, dude, ChatGPT is so much faster than Grok. So much faster, like insanely different. So let's see. This says the loss from buying to close short calls in your scenario is allowable as long as you don't establish a substantially identical short or synthetic position within 30 days. Yeah. So this looks like it would be completely fine. Okay. So, any residual questions on the example? I think this is a really cool example because it gets to really a specific way to think about positions and position management. We should always start from the point of like, what is it that I want to have on? That's the important initial step. From that point, we then want to be able to close that gap between what we have and what we want to have. And then there are a bunch of different ways to do that. We do have to take the practical impact of taxes, because the tax bill on, let's say what is the total cost of a 620 profit? I don't know if it's short term or not, so I'm just going to assume some of it's short term. So what's the total cost of 620K profit for the second highest tax bracket in state? What is it? Considering two scenarios, short term and long term. Capital gains tax. So let's just see what the tax footprint here is. And I'm going to have it give it to me in two different scenarios. So the effective rate for long term is 23.8. Hold on. Is that right? No. Hold on. What's the total? So the effective for short term is 45.3. The effective for long term is 34.1. So in this case, the 34.1 is, I mean, it's really not that different. It's only 10% difference between the two. It's actually kind of surprising. TBH. So the tax footprint on this would still be a third of it, though. Well, over a third, because the short term would be 280K. The long term would be 211K. So we effectively can flatten that out. Now, the downside to that is you still have the position open. So if this thing does start to crater, that does create a problem where if we're trying to over optimize for taxes and giving up profit, that's generally a bad choice. But there is a way to essentially wipe out the short calls, be tax effectively neutral, and maintain the long position that we ultimately want. So now the last thing that we would want to potentially figure out is what we would ultimately need to unwind in order to get this to be what we want. And it would be less than a fifth. Because if we made 144 points, let's say, I'm just going to spitball it. Let's say that we did 800 shares. That's 115K. So 144 times, let's do maybe 700 shares. That's 100,800 on the nose. So you literally would only have to unwind like between 600 and 700 shares to effectively wipe this entirely out, and then to have the rest of the position be completely uncapped upside. The downside to this approach is that you do miss having some of it in leaps, because again, even if you get a modest move, the leaps would start to pay out fucking huge. So that's kind of the cool part. That's why I'm playing it with leaps versus long stock, just because long stock is notoriously inefficient. Because in order to essentially make this same 144 point equivalent value, you really don't have to, like, you're using way less money in order to get the same general exposure. Because this is only giving you 5,000 deltas. At 133 contracts, you're literally getting 8,157 deltas. If we wanted to see what the delta equivalent position is here, let's just see what that is really fast. Fucking instinct spot on. 82. So you would need 82 contracts in order to have this very same position in terms of delta exposure. And that's not accounting for the total delta potential, because this has a total delta potential of 8,200. This is like current state. So then the cost, 4645 times 82, is 380,890. Half. Less than half. Well, no, it's half. So you literally would have half the money invested in order to get the very same exposure with more potential exposure to the upside as you gain more deltas. So synopsis for that is options are fucking cool. Be an outlier. See you guys later.